Looking for the best stocks to buy in August? I got you covered. I've got 7 stock picks today that I think are good buys at these levels and lower. The first stock, what can you really say about PayPal? In the past year, this stock is down about 35%. Year to date, it's down about 16%. And over the past 5 years, the stock is actually down 27.88%. So if I go back to August 10th of 2018, this was an $87 stock, now trading at $62.75. Right now, the market cap is about $70 billion. PE ratio says 17.53. This is 12-month trailing. We'll look closer at valuation on each of these picks as well as technical analysis. 52-week low was $58.95, and that 52-week high was $103.03. So this is getting pretty close to that 52-week low. And the forward PE right now is under 13. It's 12.98. So PayPal just reported earnings. What happened? Why is this stock selling off again? The revenue actually beat by $30 million. So revenue was $7.3 billion. That was up 7.4% year over year. So nothing stellar, but it was a gain. And the non-GAAP EPS was $1.16, and that was in line. So it wasn't an earnings miss. What happened? The answer to that is total active accounts totaled 431 million. Now that's down from 433 million at March 31st. So from the previous quarter, this is down 2 million accounts. And it's also the second straight quarter over quarter decline. Now on a positive note, the transactions actually increased. Transactions per active account increased to 54.7 from 53.1 in Q1, and it was 48.7 in Q2 of 2022. Here's a quote from CEO Dan Schulman. Our second quarter results showed continued momentum. We have high confidence that our business is on the right path, and we're seeing clear signs that the investments we've made are paying off. Our teams are energized, and I'm confident that we're well positioned to continue to grow our leadership in digital payments. Now, one thing to note here is that Dan Schulman is actually stepping down as CEO, and PayPal is in the process of trying to replace him. And we'll talk more about that later. Just a quick glance at valuation here. So price to sales, 2.61. PEG ratio is 1.56. That's not bad at all. If you can get 1 or less, that's usually a pretty decent deal. 1.56 isn't bad. And according to Fidelity, based on the data, the PE for next year's estimate, 11.4. So if we look at the historic ratios here, this is PE and price to sales. This goes back to 2019. And this orange line is going to be your PS, your price to sales ratio. Middle of 2022, that PE ratio is slightly lower, but it's fallen off a cliff from recent months. And if you go all the way back here to 2020, 2021, this PE ratio is way up there. If I zoom this chart out and go all the way back to August of 2015, you can see where it's trading at right now. It's about the cheapest that you've ever seen the stock. So next, I'm going to give you the reasons why I think PayPal stock is a buy and some commentary. Then we'll look at a chart. So let's look at trailing 12 months revenue. Right now, PayPal's trading at around 2.5. Again, trailing 12 months revenue. And I'm not trying to compare PayPal to Apple, but just for perspective, Apple trades at about 8 times 2022's revenue. And Alphabet Google is trading at about 6 times 2022 revenue. So PayPal at 2.4 looks very attractive. What's the problem? Well, before I get into the negatives, let's cover some more positives. PayPal has announced a $5 billion share buyback plan. So the plan is to buy $5 billion worth of shares in 2023. Now, right now, the total number of shares outstanding is 1.16 billion. And let's just assume that PayPal doesn't get the best price. They don't get $60 and they buy back $5 billion worth of their own shares at $80 a share. That'd be about 62.5 million shares. And that sounds like a big number, but again, the total outstanding shares is 1.16 billion. But with that said, this would boost earnings per share by about 6%. Now you have to keep in mind stock-based compensation as well. So really these help offset each other. So what are the issues? Why does nobody want to buy the stock? Well, first of all, we know that the CEO is going to leave, and Wall Street hates uncertainty. So until that new CEO is announced, this stock could be range bound for a little while. The other major threat is competition. You have huge companies like Apple that are trying to penetrate more into the fintech space. You combine that with the fact that PayPal has decelerating accounts and investors get a little bit concerned. And those reasons combined are why PayPal is being thrown in the trash. If you invest in PayPal, you have to have conviction that this company can do well in the long term. You have to have conviction that PayPal can compete and sustain in this space. So for each stock pick today, I'm going to show you a chart just really quick to show you where the stock could go and the price levels that I like. Now, I do something like this every single Wednesday in Patreon Discord. It's called Chart Day. 9 o'clock a.m. Eastern, live every Wednesday morning. We come online, we look at QQQ and 20 individual stock picks that are chosen from the community. When you see orange, that's a previous chart day. If you see yellow, that means it's today's chart day. So the RSI, the relative strength index on PayPal is around a 31. And again, it goes from 0 to 100. If you get to 70 or higher, generally you're getting overbought. You get 30 or less, generally oversold. So this is getting near oversold territory, and that could create opportunities. We know back in June, the stock bottomed out here around $67, and then it popped up, and now it's in this channel down. Most recently in May, it got to $58.95. So right now it's trading at $62.79. And I have this circled here. This is really the target. I think if this gets $60 or less, that's where I would DCA. And I do think that PayPal could be range bound, so it might trade in a range. It might trade between $58 and $70. Who knows for sure, but it could trade in that range for 2 or 3 quarters. And I think really until we have more clarity on the CEO replacement, some of the competition and so on, I think the stock's just going to trade sideways for a little while. So for long-term investors thinking 3 or more years, if you're trying to look past this and say this company does have a future, this is where you accumulate shares, and in 3, 4, 5 years, this could be a great investment. But this is really only for patient investors, and there probably still will be pressure on this stock. It's certainly possible that this stock could get down to something like $55, so keep that in mind. But I think it's getting pretty close. You get under $60, it could go a little bit lower, but I think your downside risk is somewhat limited in those price ranges. And this stock has really been washed out for a while, and there's just not a lot of buyers coming into this stock. Now, the thing about Tesla, I've been saying this for a while, it's basically like buying a green energy, a clean energy ETF. It's a conglomerate. You've got the electric vehicles, you've got the charging networks, you've got solar, you've got battery storage, and you have moonshots like robo-taxis, Optimus robots, and so on. So the last quarter was pretty strong, and the stock has ripped from its lows, and it's trying to find a footing. But the overall numbers were very positive for Tesla. It was quite a bullish earnings report, in my opinion. Free cash flow of $1 billion. You got the Cybertruck rolling off factory lines, this year, the end of this year. You have Tesla semi-trucks that are going to be ramping up here as well. So lots of strong catalysts, total addressable market, and really momentum for Tesla. And we've talked about Tesla many times in the channel. I've covered that stock, lots of due diligence, certainly watched some other videos, but just from a high level today, I want to do something different. So let's just make a broad assumption that Tesla will do something between 20 and 25% compound annual growth rate. So assuming it can keep 20 to 25% compound annual growth rate from now to 2030. Tesla would have a revenue base of around $500 billion. And right now, just ballpark, you're looking at around $100 billion. So worst case scenario with Tesla, if this just plays out and none of those moonshots come to fruition, this would still be a 5x stock in 7 years. Now, if some of those moonshots play out, like the robo-taxi or Optimus the robot, this could be much more than a 5x stock in 7 years. My bear case on Tesla, the worst case scenario, in my opinion, it's a $1,000 stock by 2030. It's trading right now around $250, $260 a share. Now, Ron Barron says the stock will be $1,500 by 2030. And Kathy Wood says it's going to be a $2,000 stock by 2027. And of course, the reason for her bull thesis is robotaxis. Now, some would argue that 2027 is just too soon for robotaxis to play out to that scale. So even though this stock isn't the cheapest it's been, you could have got it close to $100 here not too long ago. This is still, in my mind, a solid long-term investment if you're holding this for at least 4 years, to 2027 to 2030. Let's just assume that Kathy's wrong and it's not $2,000 by 2027. That's still $1,000, almost a 4x from right now. And let's just assume that she's way off and it doesn't get to $2,000 and it gets to $500. That's still 100% return in 4 years. And maybe that doesn't excite all of you, but I think that's kind of like the worst case bear scenario, honestly. And if you're making roughly 25% a year, the S&P 500 is going to give you 8 to 10%. So you're still going to beat the market with a stock like Tesla. So I'm not saying it's cheap. It's a 9.5 price to sales. The PE on next year's estimate, 55. Right now, the stock is $253.78. I like this stock, $250 or less DCA. The closer to 200, the better. And we said on a recent chart day, depending on how earnings go and if the market sells off, you could see $200 to $250. And I think we get in that range. And I know it's kind of a big range. You really just have to dollar cost average in that range. Of course, if the whole market sells off, if you get a recession, recession, all these stocks can go lower. So there's no guarantee. We're just looking at possibilities and levels that really are attractive to buy if you're thinking about a long-term investment. So in this circle here, you're getting that $250 range. When you get down to this resistance line, it's about 227. That's probably your first support if it does start to break down. Then you got these moving averages here, and this really goes from about $213 to just below $200. Now, if this goes below $200, I think that's a really strong opportunity if that happens. But I used some napkin math earlier just to show you that, even if you buy it at 250, if it goes lower, if you're holding this for 4 years, you're probably going to make money on the stock. Now, I've seen several analysts come out and say that we're really going to have this mega cycle when you think of ad tech and connected TV. And the cool thing about this next stock pick is it really does both sides. So iHub, it connects digital ad buyers and sellers together and really optimized for the best results. So this is starting to use artificial intelligence as well. You can see digital advertising, video, connected TV, retail media, and search advertising. And the company, of course, is Perion. The ticker is Peri, P-E-R-I. Just reported earnings. Earnings were pretty good, 22% year-over-year revenue growth. This isn't hyper growth or anything like that, but the valuation's pretty attractive. So non-GAAP EPS of 84 cents, beat by 18 cents. Revenue, 178.5 million. That's up 21.7% year over year, and that beat by 2.5 million. Number of average daily searches increased by 68% year over year to 28.6 million. And if you remember, I did a video just a couple weeks ago that had Perion on it, and I talked about how it really has this relationship, this partnership with Microsoft. So when you think of Microsoft Bing, this is one of the companies that benefits when you think of ChatGPT and you think of the AI search engines. Retail media is up 63% revenue growth year over year. Lots of good stuff here. Sort is basically competing against the trade desk. So if you missed the trade desk, this is a way to play something that's not nearly as expensive. This is not the best ad tech stock, in my opinion. I think trade desk is. But if you think trade desk is too expensive, this might be a good play. Let's look at valuation. So price to sales ratio is 2.42. That's not too bad. Price to book, 2.65. PE for next year's estimate, 13.4. And this is a small cap. It's a $1.66 billion market cap. The 52-week low on this was $18.81. The 52-week high, $42.75. It's trading right now at about $34.50. So going back to 2019, this purple line again here is going to be your PE ratio. That yellow line is going to be your price to sales ratio. You can see price to sales is under a 2.5. That PE ratio around 15.5. And if you look at these charts, you can see just how expensive this was at the peak, way up here. It's come way down, and it's back in these kind of historical norms. I think part of the reason the stock doesn't perform well, I think number one, it's just not very well known. And number two, I think maybe just because it's based in Israel. I don't know for sure, but it seems like a lot of the companies that are just don't perform as well. So this stock ran up to $42, $43, pulled back pretty hard. It was down here under $30, popped back up to $36.70, and right now it's trading around 35 bucks. So I don't think it's a terrible buy at $35. I would love it under $30. I think $32 or less DCA. I think it's attractive anywhere in these levels, thinking longer term. This circle here is kind of that sweet spot between a couple of these support lines, and it's also in this trend line. I think it's possible it gets to these levels. Now, it could bottom any time, and it might not get to this 50-day moving average, but I'd like to at least see it come down to the 50-day moving average. That's about $33.50. And I think that's a decent possibility. And of course, this stock could go lower. I mean, you look at all these charts, this was just a $16 stock here back in June of 2022. All right, let's talk about Alphabet. Google dominates the online search market, 90% market share. And honestly, I think that search is just a secular trend. It's going to grow with time. More people using the internet, more broadband internet connections, more Internet of Things. It's just going to grow. It's part of a secular trend. And I think that Google's going to maintain its leadership, even though Microsoft really had a first mover advantage when you think of ChatGPT, generative AI, and Bing. And I've told you this on the channel many times before. I think Microsoft benefits. The nice thing about Microsoft, it's really just icing on the cake if they get any market share at all. So it's a threat to Google in that sense if they lose some market share, but I think that market share, it's still going to be dominant and it's going to continue to grow, and there's that total addressable market that's just going to keep accelerating. And on top of that, YouTube is going to continue to grow, and you think of cloud, Google Cloud Platform, the opportunity there is enormous. And cloud is firing on all cylinders. I mean, Amazon Web Services crushed it here in the recent earnings report, and just overall that trend, when you think of cloud and software as a service, the more we use use things like AI, autonomous vehicles, all the secular growth trends we talk about, there's just going to be a need for more public cloud services. The Google Cloud Platform is number 3, of course, behind Amazon Web Services and Microsoft Azure. Now, on top of that, you have moonshots like Waymo and many others. And these are exactly what they're called, moonshots. They could be a 10x kind of investment form or a 100x investment or a zero type of a thing. It's basically like a spec play. But I think these do create significant upside on top of those other catalysts that we talk about and all these growth trends that they're participating in. Google really is a technology conglomerate. Now, here's something really interesting. Morningstar came out and said that the fair value, the price for Alphabet should be $161 a share. So is $161 accurate? I'll look at a chart. I'll give you some thoughts here. I mean, you look at the valuation. I mean, it's a $1.5 trillion market cap, so it's getting pretty big. Price to sales ratio, 5.82. That price to book, 6.26. PEG ratio, 1.77. The PE, next year's estimate, 19.3. Now, 19.3 doesn't sound too bad. And again, this is more of a mature growth stock. It's not hyper growth, but it's one of those things you put money in and you're probably not going to lose money if you're holding it 3 to 5 years. And if this is trading at $128 a share and the fair value is $161, it could be $30 upside, which wouldn't be too bad. So down here is where you should be buying, under $100 a share. And this is where most of the Discord community was buying. When it got under $100 a share, it was a pound the table buy. And now it's up here at $128, $130 a share. Now, assuming the market stays bullish, this R3 is all the way up here at $145. And so this could consolidate here and it could pop up and it really could bottom anytime. My sweet spot here would be really like $115 to $120 would be my preference, but anywhere where this yellow circle is, I really want to see it get back to the 50-day simple moving average, and that's about $123. And that might not happen because you have a support line here that's about 127, and it could bottom anytime. So if you really like the stock, you're bullish, you're thinking of holding it 3 to 5 years, I don't think this is a bad price at $128 a share. And of course, the lower the better, dollar cost average, DCA. Now I've got 3 more stock picks for you, but before I go on, if you're new here, make sure you subscribe to the channel, click that bell for notifications. And if this video is helpful, please do me a favor, drop me a like and drop me a comment. And I need to announce this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. You can also join us in our private community, Patreon Discord, by visiting patreon.com/firedupwealth. So earlier I mentioned moonshot when I was talking a couple different times. I think I mentioned it with Tesla. I also mentioned it with Alphabet Google. So I want to provide you a moonshot play. This is a spec play and it really could be a 10x or 0 and it's for long-term investors. Now Dutch Brothers is a very unique one and it won't be for everybody watching this video. A beverage company focused on speed, quality, and service, differentiated by our high degree of customization and our proprietary Blue Rebel energy drink. And here's the big one. With a long runway for growth, they have huge aspirations here, 4,000 shops in 10 to 15 years. If you're a young investor and you've got a time horizon like that, this could be like one of those next Starbucks or Chipotle's. And I like Wingstop for that reason too, because Wingstop is trying to expand. And if I were to choose one stock between Wingstop and Dutch Brothers, I'd choose Wingstop, but that might not be for you either. And you might really want to buy a coffee stock. The reality is the total addressable market, when you think of caffeine drinks and coffee drinks, people are spending money and they're going to keep spending money and probably more and more money on them. Okay, so 4,000 shops in 10 to 15 years. And according to this here, they have 838 shops right now, as of July 19, 2023. So 838 shops, possibly 4,000 shops over the next decade. And it says Texas has 167 locations, about 20% of all Dutch Brothers coffee locations in the United States. So this is a risky stock and it's not for everybody, but it could be a huge compounder with time. So the ticker on this is BROS. And of course, BROS isn't profitable at this point. So we're looking at price to sales. And this is an IPO not too long ago. Now, if you look at on your screen here in the orange, this is price to sales ratio. This is the cheapest that you could buy the stock since it came public. And it doesn't mean that it can't go lower, but it also could be an opportunity. And it's really been kind of level at this 2 price to sales here for quite a while. And so my preference on this stock really is going to be $25 to $30 DCA. And you have seen this stock come down to $25 in the past. And it kind of bounces off that, goes higher and comes back down. So this is actually trading under $29 a share right now. It closed at $28.84. I really would like it to come a little bit lower, but it could find a floor anytime. These are some bearish candles here, and I think it could come down a little bit. This is about $27, and I really think that that would be an area for me between 25 and 30 DCA, probably around $27. If it got in that level, might be an opportunity to add some shares. If you're buying this, you're probably holding it for at least 5 years, probably 5 to 10 year hold as a speculative investment. Now, STEM also just reported earnings. So revenue of $92.95 million. That was up 38.8% year over year. It did beat by 1.29 million. Earnings per share did miss. So Q2 GAAP EPS, negative 26 cents. It missed by 5 cents. This is one of those that's not profitable. It's more of a spec play, but this could be a big winner too. And it really is one of those 10x or 0 type spec plays. And some of the quick highlights on your screen, you can pause it if you need to, but backlog, $1.36 billion. That's up 88% year over year. And some decent numbers overall. It wasn't a bad quarter. Robust demand drives margin expansion. And of course, Athena software, I mean, this is really their differentiators, Athena. This is talking about their AI technology leadership. Athena continues to win recognition as the best-in-class AI software platform for these reasons and awards and so on. And this is showing Athena, OpenAI, GPT, search, metadata, and so on. So overall, the financials, I mean, they're not terrible. Of course, it's not profitable. It doesn't have the strongest balance sheet, but this company is growing and there's opportunity there, and it could be a good investment if you're willing to buy this, take a risk on it at a lower price, and hold it for several years. So STEM doesn't have a PE ratio, but we can look at price to sales, and this is basically the lowest that it's been. This stock at one point was up here at 50 price to sales. It's now under a 3 at about 2.75. Now, most of the Discord buys were between $4 and $6. I really prefer this $6 or less DCA. So you can see it close at $6.94 over here in the red. So it's just under $7. It's in the sixes. It might be okay in the sixes, but I'd prefer it if it came down a little bit lower. I've got this yellow circle and it would have to kind of break this trend, and it might not do that. So you might see 650 and it could bounce off that. And a lot of this comes down to the market. Again, technicals are not going to tell you exactly what's going to happen. It's going to give you possibilities. If the entire market decides to sell off, this is going to break down. If the market decides to go bullish next week, well, this stock could easily bottom anytime and it could rip higher. But the stock isn't that expensive. Under a 3 price to sales, it really comes down to their cash burn. Can they make it through the other end? And if they can make it through the other end, well, you could make some money on this stock. And I do own this stock in both the main portfolio and the community portfolio, and I have conviction on it. I think that the stock will do well longer term, but I do know that it's a risk, that this is one of those 10x or 0 type plays. And the good news for the shares I do have is they were bought much lower, between $4 and $6 a share. All right, this last stock just reported earnings as well. Now, Q2 GAAP EPS, 39 cents in line. Revenue, $1.85 billion. That was up 11.4% year over year. It missed by 20 million. And this quarter was primarily impacted by foreign exchange rates.
Time for a key bump.
Now, Monster Beverage just acquired Bang Energy, and they're also getting into lots of different other areas. They actually have acquired several different breweries. They've got seltzers. There's lots going on at Monster. And just to give you a quick idea, it's not just energy drinks. We're talking about craft brewery here, IPAs and beers and so on, seltzers. You've got Dale's, Wild Basin Hard Seltzer. And if you want a deeper dive on Monster, there's a card above. You can go check out that video. Now, this stock is not cheap by any means, but I do think it's attractive, and I'll show you a chart here in a second. Price to sales ratio is 9, and that PE ratio is a 45. If you look at the forward PE, it's about a 35.81. So I like Monster, 55 or less DCA. My preference here would be below $50. I hope this video was helpful. Make sure you subscribe to the channel, click that bell for notifications, drop me a like, drop me a comment. Have a great rest of your day. Take care.